me right now to react is the former Reagan economist and the author of Trumponomics, Art Laffer. Art, great to see you. Thanks so much. So much to talk about with you this morning, from inflation to supply shortages to the Fed. Where shall we start? What's most important in terms of your standpoint? Give us your reaction to this data.
Well, I think Cheryl's completely correct. These numbers really reflect a supply shortage of both goods and services coming in from abroad or here, as well as labor. We have a very tight labor market, primarily because people have left the labor force. And that's what I'd like to really focus on, is because of all this government spending and because of all of these resources that have been transferred to people, they don't feel it's imperative for them to go to work. And you can see the participation rate in the labor force dropping quite sharply. If that trend continues, and there's no sign that it's not going to continue, if that trend continues, that would bode very poorly for the U.S. economy over the long run, very poorly.
Well, Art, 4.4 million people dropped out of the workforce in the month of September. Why?
Because they've got payments that they don't have to work, Maria. The incentive, the push, the imperative of work is no longer there because they're getting government payments that are alleviating any type of need for income. So therefore, they just leave the labor force. They don't like their jobs terribly, and even at $20 an hour or so, they'd much rather not work than work, and thus they're going to lose the skills, they're going to lose the experience, the ability to be good, productive members of the labor force in the future. And the longer they stay out, the worse it's going to be for the U.S. economy over the long haul.
I mean, do you find it odd that we have inflation in our faces right now, stoked over and over again, 60% increase in gasoline, 25% increase in hotel stays, food up in the double digits, and yet the Democrats are still pushing through this spending and tax plan? You just talked about all these people leaving the workforce, and yet they're still wanting more checks to go to people. I mean, is this extraordinary?
It is extraordinary, and it's really bad economics. This plan, this Build Back Better, or whatever, Build Backwards Better, I like to call it, really will cause people to leave the labor force, not join it. The higher taxes will destroy the incentives for people to invest and increase production base, and you will find the supply of goods declining, and with all of this new spending, there'll be more demand, and that will only increase the rate of inflation going forward, in my view. All of the signs here are there. Everything they're doing, Maria, is in the wrong direction. Everything.
Yeah, exactly. I want to bring in the panel. Dagan, we know now that the chairman of the Fed has signaled, as we expected, 3 interest rate hikes next year, another 3 in 2023. Art, we want to talk about that, but Dagan, take it away.
Art, it just feels, and I will reference the Wall Street Journal editorial today on this very thing. It was a lot of talk, no walk. And this was expected. Clearly, it's dovish for the markets, and the asset bubble will continue to inflate, as witnessed by the market reaction yesterday. This is way too late. And after all of this unprecedented monetary stimulus, is there any way in your mind that Jay Powell and company can land this plane without crashing it?
I don't think so, Dagan. I really don't. I mean, once you've got this type of policy in place, you need ever and ever greater shots of the policies just to keep the system going. It's like an addiction. And if you think about these rates that they're going to raise, if you've got a 7% rate of inflation going on, which may be too high or too low within recent numbers, but that means that a rate of 1% means you're actually losing value. You're losing value if you're lending money because your interest rate doesn't even cover the rate of inflation. So by holding that down, it distorts the lending market, the capital markets, the banking system dramatically. What Powell should do is just get out of buying government bonds. Just stop and let the markets clear. I mean, there are going to be some rough patches if he does that, but that's a lot better for the long run, the longer he lasts, the greater will be the adjustment, and it'll not be pleasant.
So, Art, I mean, as rates go higher, doesn't that slow down the macro story, the economic growth story? Doesn't that also create competition for stocks?
Well, it does. It does do all of those things in the short run, but in the long run, what you've got is by lending money, you're losing it. The return you have on lending money is negative now because you've got more inflation taking away your capital than the interest covers it. So it's completely distorted the capital markets from a free market. And the only one borrowing, I mean, literally borrowing, is the government. I mean, they're just doing it all the time. And it's really a shocking phenomenon that's happening.
Yeah,
and I don't know how
is.
the Fed gets out of it without causing a destruction of the capital. Interest rates today, Maria, should be in the 5-6% 10-year bond yield, maybe even higher with the rate of inflation we have now. Inflation leads to higher interest rates, not lower interest rates. So when you say high interest rates, at 20% rates of inflation, believe me when I tell you, interest rates won't be low. In a free market, they'll be very, very high. I don't know if you remember the olden days when countries had devaluing currencies, very high interest rates. I mean, that is not the world you want us to go into, and that is the world that Powell and the Fed are taking us into very, very rapidly.
And here we are sitting with a yield on the 10-year below 1.5% right now, Art. Great to get your analysis on all of that. Thank you so much.
Thank you. My advice to everyone is don't lend money to the government.
Don't lend that. There you go. I was like, wait, you got to give us your advice. Art Laffer, good to see you, sir. Thank you.